it is very risky here,
Right.
what happens to the bond market. So people need to keep an eye on it. The equity market might not like it either. Even the
Right.
crypto markets may not like it.
That's Raoul, CEO and co-founder of Real Vision. And in today's video, he's going to be talking about how the bond market could really affect the crypto and equity market here over the next couple of months. It could potentially send the crypto market crashing. So you'll definitely want to stay tuned to the end of this one. And if you guys are new to the channel, my name is Aaron from the Bitcoin Bros. We have new crypto and Bitcoin videos coming out every single day. We try to keep you guys up to date the best we can on our channel on everything finance, so make sure to subscribe. We do appreciate that if you decide to subscribe. But like I was saying, Raul's talking about what's going to happen next in the economy, inflation, the bond market, and how all of this will affect crypto and the equity market. So like I said, I recommend you guys watch this one all the way to the end. A lot of great and useful information in this one. Make sure to leave your thoughts in the comment section below. Let's go ahead and check out this clip.
Um, I've thought bond yields will come lower. And I've spent a long time actually thinking about this. I say that flippantly, but actually I spent a long time thinking about this because all of the business cycle indicators, all of the inflation, forward-looking inflation indicators, all of the unemployment indicators are all suggesting that bond yields should come down and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? While equity markets already started pricing in the fact that there's more liquidity in the system. And I think it's down to supply. I think it's really down to supply because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff, and there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates because before you know it, the budget deficit explodes high.
Right.
So there's a game that I think they're playing here is the Federal Reserve have to, and all the central banks are doing the same game because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. So I think the narrative will break by Q4 when we'll start to see the Fed cutting aggressively. In the meantime, do yields go higher? I don't know. I'm watching them closely. There's a risk that they do, and I'm stuck in a bond trade that's losing money. I've had a great year on technology and crypto, and having a offset some of that in bonds. So I still think bond yields end lower, but there is a risk that they lose control here because of the supply side, and there's not enough liquidity in the bond market right now. And therefore, I think that increases the chance of some yield curve control, whether it's like an intervention in the bond market. And we've seen that in the past. It's not uncommon for the US to do. Japan obviously does it. The UK did it recently as well. So listen, I think this turns around, but could it squeeze higher first yields? For sure. Yeah, so again, it's this issue of the Fed staying as long as possible because they really want to have the complete green light to do what they want, crush inflation expectations. The market knows rates are too high, obviously. So they're saying, listen, you can't do this for long.
Right.
And the Fed keeps shunting them along. And this is the higher for longer argument, which has been pretty accurate. And the question is how fast does it reverse? And the market never usually forecasts this right. Normally, once they do cut, they cut faster than the SOFR curve or the Eurodollar curve used to in the past. So we have to wait and see. But it's all to play for in Q4 for me. So if rates become unanchored from inflation, economic growth, or anything else, It says there's a structural problem in the market. We know there's massive structural problems in the lending markets because there's too much debt. And if you lose control, the Federal Reserve can't allow loss of control. And don't forget, they're just being downgraded because of the shitty mess that the US is in because of its political impasses and everything else. Is if they lose control of the bond market, just that's the world's anchoring asset. This should not be allowed to happen. So in which case, they will come in and stop it. And we saw that in March of 2020. They did the same where rates got ridiculous on the other side, going down, just completely, all liquidity dried up and the market broke. We have a risk that we could break the market again here. And in which case they'll step in and say, we'll have to increase quantitative easing and buy bonds. But you could do it at a fixed price and say, we'll buy all bonds at 4.25% or whatever the number is, that they say, look, enough's enough. We know that the regional banks have problems with their bond positions. And if bond yields keep rising, they keep losing money. That makes them illiquid. And with high rates, there's money moving from deposit accounts in banks that are only paying 0.5% and moving to money market funds that are paying 5%. So they're losing their deposits and they've got losses here. Every time you take a deposit out, you have to kind of unwind some of the trades, but they're all down. So there's a huge, massive mark-to-market loss that goes on. And they're having to borrow money from the Fed to fund that right now. So in this financing facility that the Fed set up. Also, if the bond market breaks, it means that there is not enough participation from the key participants, banks, asset managers, market makers, to keep market liquidity. So prices start gapping around, setting interest rates which were not the intention of the Federal Reserve. And if they're setting interest rates that were not the intention of the Federal Reserve in a very meaningful way, then it can create problems. So it is very risky here, what happens to the bond market. So people need to keep an eye on it. The equity market might not like it either. Even the crypto markets may not like it if yields go up, because that puts pressure on everybody on their borrowing costs. Now, most mortgages in the United States are longer duration, but we've seen credit card financing rise. We've seen car leases rise. We've seen all forms of short-term financing rising. Corporations rolling over debt if they've got short-term debt, that's going up. And the US government themselves need to fund their bloody debt, right? And they're rolling over all of this debt. And the last thing they want to do is try and roll out 10-year debt at 4.5%, when the last time they were paying the interest on it, it was 1.5%. Suddenly you triple your interest payments, and then you have to borrow more money to have the interest payments because the taxation rate's low. We've got some dangerous dynamics here, which is why they need to cut rates.
Thank you for watching all the way to the end. Leave your thoughts in the comment section below. Definitely love to hear from you guys. My name is Aaron from Bitcoin Bros. I'll see you guys in the next one, and have a great rest of your day.